Every chart you open is alive. Not with numbers, not with lines, but with human emotions. Behind every candle is someone chasing profit, someone else fearing loss, and many regretting a decision they can't take back. Now think about those supply and demand zones you draw. Those rectangles aren't just fancy boxes. They're battlefields of psychology, where greed collides with fear, and where the strong feed off the weak. But here's the question. Why do these zones work again and again? Why does price stop, reverse, or explode at those levels as if they carry some invisible force? The answer isn't magic. It's psychology. And once you understand it, you stop seeing supply and demand as rectangles, and start seeing them as the footprints of the market's collective mind. Let's start with supply zones. What do they really represent? Not just resistance, not just a ceiling. A supply zone is the place where sellers take control of buyers' emotions. Think about it. The first time price shoots up into that level, big players, institutions, smart money, the ones with deep pockets, are waiting. They unload massive positions, creating that invisible wall. But it doesn't stop there. When price pulls back later, something interesting happens. Traders who bought too late on the last rally are stuck. They've been holding a losing position, feeling that ache in their stomach. And the moment price returns to that level, they breathe a sigh of relief. Finally, I can get out at break even. So what do? They sell. Now layer in the fresh short sellers piling in. You have trapped buyers desperate to escape, and aggressive sellers striking at the same time. That's why supply zones hold. They are the graveyards of late buyers, where hope quietly turns into surrender. It's not the rectangle on the chart that matters. It's the fear of loss and the urgency to escape that keeps supply zones alive. If supply zones are the graveyards of late buyers, demand zones are their opposite. They're the birthplace of recovery and hope. Picture this. Price drops hard, panic sets in, and retail traders start selling in fear. But right at those levels, the big players are doing the opposite. They're quietly scooping up contracts, buying from the fearful, turning panic into opportunity. When price bounces, the psychology flips. Traders who hesitated to buy earlier now feel the sting of regret. They think, I knew I should have entered. I won't miss it next time. So the next time price revisits that zone, they rush in. That's demand psychology, fear giving way to FOMO. And it's not just retail. Institutions also leave unfilled orders at those levels. They want more and they wait for price to revisit. So when it does, fresh demand collides with late sellers who are now trying to cover. This is why demand zones work. They are fueled by the fear of missing out and the hope of catching the bottom. A demand zone is less about price and more about human emotion. It's where despair turns into greed. Here's something fascinating about supply and demand zones. They don't just appear once and vanish. Price often revisits them, sometimes weeks or even months later. Why? Because the market has a memory. Think about your own trading psychology. When you take a painful loss at a certain price level, that number sticks in your head. When you miss a winning entry, you remember it too. Multiply that across millions of traders, and you see why zones carry weight. Supply and demand zones are like bookmarks in the market story. They mark unfinished business. Traders trapped in losing positions are waiting to get out. Institutions with unfilled orders are waiting to finish. New traders, remembering the bounce or the rejection, are ready to jump in next time. It's not just lines on a chart. It's the collective memory of fear, regret, and anticipation. And that's why when price returns to these zones, emotions flood back. The market remembers, and it reacts. Here's the brutal truth. Supply and demand zones don't just work because of psychology. They also work because psychology is exploited. Big players know exactly where retail traders place their stop losses. They know buyers set stops just below demand zones and sellers place theirs just above supply zones. That's why you'll often see price dip just far enough to trigger those stops before snapping back. This is what we call the pain trade. Imagine being long at a demand zone, Price wicks down, tags your stop, kicks you out, and then immediately rockets in the direction you predicted. The pain you feel? That's not an accident. That's liquidity being harvested. The cycle is always the same. Disbelief, hope, greed, regret. And the big players thrive on it. Zones become psychological traps, designed to punish the impatient and reward the disciplined. In other words, supply and demand aren't just battlefields of emotion. They're also hunting grounds. And if you don't understand that, you're the prey. Here's the thing. Supply and demand zones aren't the problem. We are. Most traders sabotage themselves around these levels because they let psychology, not discipline, take the driver's seat. The first mistake? Impatience. They see price approaching a zone and jump in early, without waiting for confirmation. Why? Because the brain whispers, what if it takes off without me? That's FOMO at work. Second mistake, bias over discipline. Once a trader has drawn a rectangle, they suddenly see it everywhere. Every pullback feels like a zone. Every candle becomes a signal. This isn't trading, it's wishful thinking dressed as analysis. Third mistake, revenge trading. When a zone fails, and they do fail, many traders can't accept it. Instead of cutting their loss, they double down. They trade not the chart, but their emotions. And perhaps the biggest mistake, treating zones like magic boxes. They forget that a supply zone is just trapped buyers and aggressive sellers, and a demand zone is just accumulation and FOMO. Without that understanding, traders start worshipping rectangles instead of reading psychology. The truth is, zones don't fail you, your psychology does. So how do you escape the trap? How do you stop being prey and start trading zones like the professionals? First, think like institutions. They don't chase price. They wait for liquidity. That means being patient enough to let the zone play out. If it breaks, fine. If it holds, even better. But they never rush. Patience is their edge. Second, accept zones as probabilities, not guarantees. No zone is sacred. A demand zone can crumble. A supply zone can break. The key is to treat them as high probability areas, not certainties. When you let go of the need to be right, you trade with clarity. Third, see emotions on the chart. When you mark a zone, don't just see a rectangle. See the fear of trapped buyers. See the regret of missed sellers. See the FOMO of latecomers. Zones are just visualized psychology. Learn to read the emotions, and the zones make sense. Finally, discipline over ego. The market doesn't reward predictions. It rewards execution. Set your plan, wait for your signal, and trade with discipline. Because in supply and demand, patience isn't just a virtue, it's profit. Supply and demand zones are not magic rectangles. They're the footprints of human emotion stamped into the chart. Every supply zone tells the story of greed turning into fear. Every demand zone whispers of panic transforming into hope. And every revisit to these levels proves that the market, like the human brain, never forgets. The difference between traders who thrive and those who bleed is simple. One sees zones as psychology, the other sees them as drawings. So the next time you mark your chart, don't just see price. See the crowd's fear. See their regret. See their desperation to escape or their hunger to join. Because if you can read the emotions behind the candles, you stop trading against the herd and start trading against their psychology. That's how you step out of the crowd. That's how you trade supply and demand with clarity.